All right, so good evening, everyone. I want to welcome you to the boot camp once again. And tonight we're going to be looking at chart patterns. Now, I'm your host tonight, and my name remains Rotimi Olawale. So let's get started. So if you're watching from any part of the country, this is PU Prime, and we have our global head office in Australia, while we have two offices in Nigeria, the Abuja office, and which is the head office for Nigeria, and the regional office, which is the Lagos office. And we run trainings, physical trainings at these two locations, Tuesdays and Thursdays every week. And currently we're running an online boot camp, so that we can just compress all our training sessions for yourself, our customers, our clients rather. So let's start. All right, so tonight we're looking at chart patterns. Now, right from the beginning of this training, we've gone through different phases from the beginners class. We've taught you what the global financial market is, participants in global financial markets, categories of currency pairs. We looked at the MetaTrader platform. We looked at technical analysis, talking about support and resistance, trend, and all the likes. And in the last class, we looked at candlestick patterns. And today, we're taking it a step further into what is called chart patterns. So what are chart patterns? We say a chart pattern is a visual formation or shape within a price chart that provides clues to what prices might do next. Take note of that. I'll read it again. A chart pattern is a visual formation. From the word visual formation, it means it's something you identify by sight. Merely by looking at it, you can identify it. That's the visual formation or a shape within a price chart. So this visual formation or shape will appear within a chart, and it gives you clues to what price might do next. That tells you that this kind of visual formation or shape can be predictive. It can predict the next move, of the market, the next move of what price will do in the market. And we say that they provide a framework to analyze the battle between bulls and bears and can help determine who is winning, allowing traders to position themselves accordingly. Now, I want you to know that in trading, forex trading, generally in global financial markets, there's always a battle between the bulls and the bears. The bulls are those who are pushing the price higher, while the bears are those who are pushing the price lower. So generally speaking, when there are more buyers than sellers, the market will go in a bullish direction. And when there are more sellers than buyers, the market will go in a bearish direction. So when there are equal number of buyers and sellers, the market will experience a state of equilibrium, where it's not buying, neither is it selling, and such can be said when the market is said to be in a ranging trend in the market. So we say that these chart patterns can provide a framework for us to analyze the battle between the bulls and the bears, that is to know who is winning, whether it's a bull that is winning so that the price can go bullish, or whether it's the bears that are winning so that the market can go bearish. And this can allow traders to position themselves. So what the chart patterns do for us is that they predict what will happen next to price and give us an opportunity to prepare and position ourselves ahead of that next move of the market. So they give us a heads on, we know ahead and we can put. So if you see a pattern that will tell you that the market is going to buy, you have seen it earlier, and all you do is position yourself to harvest a profit as price eventually goes into that same direction. Now, these are the list of the chart patterns, the ones that are generally acceptable that you will see more often in the market. These are the list. So we call them list of classic chart patterns. Number one, we have double top and double bottom. We have head and shoulder slash inverse head and shoulder, rising and falling wedges, bullish and bearish rectangles, bearish and bullish pennants, and we have the triangles, symmetrical triangle, ascending triangle, and descending triangle. And we're going to look at all of this in this class tonight. So I want to just sit down, relax, and just ride with us, because you're going to get tips that will change the game for you in forex trading. just like a change mind. I'm telling you, just like a change mind, this is really going to change the game for you. So if you've been there, you've been trading, not being consistently profitable, just follow us tonight. When you get your hands on this chart, I tell you, your profitability will improve beyond what you were experiencing before. So, but one thing I should let you know is that these chart patterns give us direction of where the market is going. If it's going to go bullish, it will tell you. If it's going to go bearish, it's going to tell you. Without any assumption, you will know ahead and you can position yourselves for the next big move. So we'll start with the first one, which is double top. Now, double top pattern. Now, double top pattern gives us an insight into when the market is reversing from the bullish trend to the bearish direction. That is what the double top pattern tells us. And don't forget the definition of these chart patterns. We say that they are visual formation or shapes. Now, the double top pattern actually looks a lot like a letter M. Don't forget the word visual formation or shapes. So how do we identify this pattern? You identify this pattern when you see price going in an uptrend. Price makes a high, drops to a low, goes up again to form another high. But this time around, the new high is on the same level as the previous high, and most of the time it forms a resistance. We've done resistance and support, in one of the classes. So it forms a resistance, and technically when price hits a resistance, we say that we expect a decline in price. Why? Because a resistance is a seller's zone. There are abundance of sellers at resistance that will push price down. So because it hit a resistance there, on the two previous high, we experience a decline. So price drops. Now price drops now to the tip of the letter M. It drops back to the same level. Now this tip of the letter M now is called the neckline. That's the name. And price is expected to break out downwards once it breaks below the tip, which is the neckline. Now, a word of caution here, like I said earlier, price will make a high, drop low, make a second high, hit resistance, drop to the neckline. So what we're trading is actually the second leg of that letter M. That is what we're trading. That is just what we're looking at trading. So I believe all of us are lettered. You can write your alphabet. So it's just using letters now to trade forex. I tell you that's just a very simple thing to do. So we're just looking for price to drop from the second high, which is the resistance level, to the neckline, and afterwards we look at an opportunity as price gets to the neckline and breaks out below the neckline to take a sell on the instrument. So this is the example, the full one right here. Price makes a high, drops, makes a second high, hits resistance, drops, and then now it should be noted that when price breaks out below the neckline, it always moves it's always a massive breakout. You can see this massive bearish candle, then afterwards you can see that price still kept dropping lower. Now, sometimes it might be advisable that you take this this double top pattern, you trade it with a pending order. So we're not saying you cannot trade it through direct, breakout of price below the neckline. You can, but sometimes the rate at which price breaks out below the neckline, can be so massive with so much volatility that if you don't enter earlier, you might miss some of the action. You can imagine missing this big candle. Yes, you can still ride the remaining trend downwards, but I tell you, this is actually a large chunk of move out there that one could have missed. So in order to avoid that, you can actually put a sell stop order at the tip of the neckline, the candle that hits that makes the tip of the neckline, the shadow below that candle, you can use that as the entry price. So you can just place a sell stop order right there so that you don't miss out of the action as price breaks out downwards. So that's the double top pattern. And next, the opposite of it. So the double top pattern tells us to look for opportunity, for bearish opportunity. So that's it for you. So once you see a double top, you know the market is going to sell. And the next one to it is the opposite of it. That's the double bottom pattern. So while the double top looks like letter M, the double bottom looks like letter W. That's it, letter W. So the opposite is what happens here. Price makes a low, goes up to the tip, makes a second low, which forms a support, pushes back up, hits the neckline, like I said, a buy stop, and we trade the second leg of the W pattern. And that's what we have right here. A low, the neckline, the second low, support, a breakout, a buy stop order, and you see the trade triggered. So the double bottom pattern gives us a bullish trade, while the double top gives us a bearish trade. So that's just the simplicity of these patterns. They tell you the direction ahead. There's no guessing. When you see the pattern form, you know where the market is going next. The next pattern I want to look at is the head and shoulder pattern. The head and shoulder pattern. And this is how this works. All of us, we have our head and shoulder, like those rhymes we used to read back in primary school: my head, my shoulder, my knees, my toes, something like that. Now, in an uptrend, price makes a high, drops down low, makes a second high, which is higher than the previous high, drops down low, now goes high again a third time. Now, this time around, this pattern is called a head. There's a head, where you have the highest point, the most recent high. Then we have the shoulder, the second shoulder. Now, price drops again. Now, the line that joins the tip of the shoulder, the two shoulders right here, is what is called the neckline. So what we're trading now is the breakout of price downwards. It's like price is doing a reversal pattern. That is what it's doing, from uptrend to downtrend. So it's the second shoulder. It's the breakout below the neckline from the second shoulder downwards. That is what we're looking at trading. And that's what is represented in the diagram, by the side. We have the head and shoulder and a bearish breakout. Now, just like the double top, the best way to trade this also is that you can set a sell stop order, a pending order, at the tip of the candle, that's part of the neckline, the one that shoots out below most. You can just use the tip to do a sell stop order as we anticipate that price will break out. You can see there's also a massive bearish breakout here also, just like we had on the double top pattern. So this is a head and shoulder pattern. It's a bearish pattern. Whenever we see it, it indicates we are looking for opportunity to sell in the market. So the opposite of the head and shoulder is the inverse head and shoulder. So while the head and shoulder is a bearish pattern, the inverse head and shoulder is a bullish pattern. Price makes a low, a lower low, another low. So this forms shoulder, head, second shoulder, a breakout to the neckline, and we see price breaking out upwards. So what we're trading is the breakout above the neckline, which you can always use the tip of the neckline as a pending order just to trigger you in. Now, one of the beautiful things about this is that if you see this pattern ahead, you don't need to stay glued to your system. You can just put the pending order and the price will be triggered, when it gets to that level. But if you feel you want to trade manually, you are equally welcome. But one of the best ways to do it is to set a pending order to capture the move as early as possible. So that's the inverse head and shoulder pattern. Now, the third pattern we'll look at is called the rising wedge pattern, rising wedge. Now, the rising wedge pattern is formed when price is in an uptrend. Price is in an uptrend, and we now draw trend line on both sides of price. Now, from the word rising wedge, it means price is rising, but then it gets to a point that price will now, experience a consolidation at the tip of the two trend lines. A consolidation will occur there. So from that point, price now breaks out downwards. So even though price is rising, if we call it a rising wedge, which means price is trending up, we are actually expecting a bearish breakout in price. So in other words, this rising wedge pattern is to give us bearish opportunity, a bearish breakout. So when price gets consolidated within the pattern, the rising wedge, then we now wait for the breakout. And that comes through what is called a breakout candle. A breakout candle is a candle that comes, from within the pattern and breaks the trend line downwards. So we'll call it a breakout candle. So when you see this breakout candle, it will project from within the pattern and breaks the trend line downwards. At the close of that candle, you can now trigger a sell. So that's a rising wedge pattern. Next is a falling wedge pattern. From the word falling wedge, it means the trend is dropping. We're seeing a decline in price, but then price is expected to break out. We're expected to find a breakout candle. And once you're able to find a breakout candle, you can trigger a bullish trade. And next to that, just a minute. All right. So next to that, we have the rectangle pattern. The rectangle. Now, the rectangles are formed when price is more or less in a range, when price is bound between resistance and support and is moving within the resistance and support pattern. That is when we have, a rectangle pattern. A rectangle pattern. That's when we have a rectangle pattern. You can see in this instance, price is just moving, bouncing between the resistance and support, and it's just keep bouncing like that. Now, the rectangle pattern now can be divided into two. We have the bullish rectangles and the bearish rectangles. So in an uptrend, when price is trending up, it's possible to find a bullish rectangle pattern in an uptrend. As you can see in the diagram on the screen, price is in an uptrend, and it gets to a point in that uptrend, we can see a rectangle pattern. So how do we trade this? We'll wait again for a breakout candle. That is a candle that breaks out above the upper part, above the resistance. Now, you should be noted with this pattern, we call it a bullish rectangle. That means it's a continuation pattern. It's not a reversal pattern like the patterns we've been seeing so far, like the double top, the head and shoulder, the rising wedge, they are all reversal pattern. But the rectangle patterns are continuation pattern, meaning that price continues in its original direction. Like in this instance now, the trend is uptrend. You can see this blue arrow. It indicates it's an uptrend. If you come here as an uptrend, then price enters into this rectangle like a kind of a consolidation. Then price breaks out with a breakout candle. And you see that price continues going bullish in line with the original direction. So rectangle patterns, the bullish rectangle pattern is a continuation pattern. And the next to it is a bearish rectangle pattern. This from the name is, when you have price in a downtrend like this and price enters into this consolidation, we get a breakout candle. And at the close of that breakout candle, we trigger a trade in the bearish direction. So that is a bearish rectangle. And next is what we call a pennant. Now, a pennant also is a continuation pattern. Now, a pennant is found, there are bullish pennants and bearish pennants. A bullish pennant is found in an uptrend. It's actually a minor consolidation when price is in an uptrend. And that consolidation is so small that it looks slightly like a triangle. It's like a small triangle within an uptrend. Then price, you can see there is a breakout candle, price breaks out, and from there, we see price continue in the bullish direction. So that's a bullish pennant. And the opposite of it is a bearish pennant, which is also a bearish consolidation pattern. Price is trending down. It enters into this small, tiny triangle, breaks out. You can see clearly the breakout candle. At the close of that candle, you can trigger a sell, and you can see that price continues selling further. Then we'll look at the triangle patterns. Now, there are three of the triangle patterns. We have the symmetrical triangle, the ascending triangle, and the descending triangle. Now, the symmetrical triangle is a very, very unique triangle pattern. If I say it's a very unique pattern when it comes to forex trading, because it's the only pattern that can give us a dual direction of price. Now, it's a triangle. If you look at it, it looks as if it's a pennant. Though the only difference about the symmetrical triangle is that it can happen anywhere. It's not dependent. It's not like the bullish pennant that happens in a bullish trend, bearish in a bearish trend. This one can happen independently on its own. It doesn't have to be a part of any major trend. It can just be independent. Now, the unique thing about this symmetrical triangle is that if this pattern forms, or whenever it forms, if price breaks out upward, then it means we are looking for an opportunity to buy. Once the breakout candle breaks out above the triangle, you can trigger a buy trade. The same thing if the breakout is downwards, you can trigger a sell trade. So don't forget that price, will consolidate within this triangle, building pressure within it, and break out in one direction. For example, here it broke out upwards, and you can see it's an uptrend, it's a bullish trading opportunity. If it had broken out downwards, it would have been an opportunity to sell. So wherever it breaks out, that is where the market is going. So that's the symmetrical triangle. Then we have the ascending triangle. Now the ascending triangle is formed when price is reversing from an uptrend again to a downtrend, but this time around in a triangle pattern. So how is it formed? You can see price makes an uptrend here. Then it hits a resistance rather. This level here is a resistance. An uptrend, a resistance. So when you found the resistance, you can now draw a trend line, and that's what completes it to be a triangle. And what we're trading is whenever price breaks out below that triangle, below that trend line, and that gives us our ascending triangle. From the word ascend, it means it's trending up in order to reverse downwards. So it breaks out below the trend line, and from there we look for opportunity to sell. And finally, we look at the descending triangle. From the word descending, it means price is dropping low. It hits a support and a consolidation, and we expect a breakout in the bullish direction. So in mathematics, this pattern, this descending triangle is what in maths those days, you can easily call it like a right angle triangle. That's why we say that these patterns, these chart patterns, they are visual formation or shapes. This one looks a lot like a right angle triangle. Then price drops low, hits a support, enters a consolidation, a breakout candle, and you can look for an opportunity to buy. And that's all in this training tonight. Yeah, don't go yet. We're still going to go on the screen on MetaTrader to see a few examples of this pattern. So tonight we've looked at the most consistent types of chart pattern you can find in the Forex market. We looked at the double top and the double bottom, the head and shoulder, and we said that the double top is a bearish pattern, the double bottom is a bullish pattern. I think it's best we just do a little flashback so that we just refresh our memory on this. So this is the double top, is a bearish pattern. The double bottom is a bullish pattern. The head and shoulder is a bearish pattern. The inverse head and shoulder is a bullish pattern. Rising wedge is a bearish pattern. Falling wedge is a bullish pattern. Rectangle, the bullish rectangle is a bullish continuation pattern. The bearish rectangle is a bearish continuation pattern. The bullish pennant is a bullish continuation pattern. The bearish pennant is a bearish continuation pattern. And the triangles, I said the symmetrical triangle is unique because price can break out on either side. Wherever the price breaks out, that is where price is going at that time. If it breaks out bullish, it means we have a bullish signal. If it breaks out bearish, it means we have a bearish trading opportunity. Then we have the ascending triangle, which breaks out in the bearish direction for an opportunity to sell, and a descending triangle, which breaks out upward, giving an opportunity for a bullish trade. So that will be all tonight. So I'll flip now to the MetaTrader platform and we'll look at some examples of these patterns we have listed right now. So the first one I'm going to show us is on US oil. Now, it should be noted that these patterns can be discovered on any time frame. There is no limitation, though I will advise lower time frames from 15 minutes. Well, 15 minutes sometimes can be okay, but 5 minutes and 1 minute, I will advise you avoid such lower time frame. Uh, most of them are more consistent from 1 hour time frame and above. They are much more consistent. If you find them on 4 hour time frame, perfect daily time frame, excellent weekly time frame, the higher the time frame, the stronger all these patterns are. So I want to look at the US oil. Sometime last year, there was a pattern like this on the US oil, and I cited it. I gave an analysis on it towards the end of last year, and that's a head and shoulder pattern, which led to about 1,955 pip movement, on US oil to close the year 2023. That's a head, a shoulder, a head, a second shoulder, and a massive breakout. Here is the neckline. This is the neckline right here. And you can see once a new candle opens below the neckline, you can see a free fall of price downwards in the bearish direction. That's on the weekly time frame. Let's go to the daily so that you can see it clearer. And you see still the same thing. And you will always, if you're patient, you will always find these patterns. Okay, this is another head and shoulder on the US oil. This one, I think, is a more recent pattern. Shoulder, head.
We are not displaying
Please,
it, sir.
change
Oh,
your.
pardon me, pardon me, pardon me. All right, you should see it now. Can you see my screen now?
Not yet.
Okay, it's
Okay.
going to load. You can see
Yes,
it
yes.
now. All right, good. So I'll go back. So let me zoom out so that I can see clearly. Apologies for that. All right, so I said towards the end of last year, there was an analysis I gave about the US oil. I saw a head and shoulder pattern information. Now, let me just say this also. Now, sometimes some of these patterns will not be as beautiful as you saw it in the manual. Though for starters, look for the ones that look very perfect. But over time, sometimes it may not look 100% perfect, but by experience, you'll be able to cite them. So I'll show you the ones I've taken at one time or the other. This is a shoulder. This is a head. And this is a second shoulder. And this gave about 1,900 pips breakout on US oil to close the year 2023. Now, this is this head and shoulder on the weekly time frame. If you want to check it out on the daily time frame, you can do that. We just click on the daily time frame and we'll get it. We'll flip backwards. Yeah, this is it right here. Oh, sorry, the MT4. I need to push. Okay. So this is the shoulder, the head, the second shoulder, and that's the breakout. And also in recent times, there's equally another head and shoulder breakout. Here we have a shoulder on the same US oil, a head, a second shoulder, and a breakout, a kind of a retracement and further breakout. So these patterns are very consistent. Let me show you more examples. On Euro AUD, I think last week, or I don't think it's up to 2 weeks, maybe sometime last week, thereabouts, I gave an analysis on Euro AUD. I said I cited the head and shoulder. This is a shoulder, a very long head, a second shoulder, and a breakout. This is a retracement, but then we're having a continuation, and price is still expected to still drop further. This is still a running setup though. Let's look out for another one. On EuroCAD, this one is a running setup. If you belong to the funded client group. If you're not yet in the funded group, make sure you have a funded account immediately after this class and let your account manager add you to that group. You cannot miss what people are enjoying in the funded clients group. Now, like I said, sometimes some of these patterns requires the eyes of experience. But by experience, I can cite some of these things. This is a shoulder, a head, a second shoulder. I gave this signal 2 days ago, and currently it has dropped about 80 pips, thereabout. Please, there's a lot, somebody's device is giving noise there. Kindly mute your device as you join us. So this is the head and shoulder pattern, and we're already seeing some drop. All right, so I think I should be done with head and shoulder. Let's look at another pattern. Now we want to look at a double top. There was a double top pattern on the USD CHF.
Please, sir, can you take it to the lower time for like 1 hour, sir? On the 1 hour.
We have to start scanning. That's the thing. I find it easier you can go down to lower time frame, but for me now, I don't have a fresh one on lower time frame. So I have to start. Okay, I think I found one. I found one just now. This is 1 hour time frame. This is an inverse head and shoulder. You can see there on Eurocard. That's an inverse head and shoulder. So you can find them on any time frame. But like I said, avoid 1 minute and 5 minutes. Those ones may not be too stable. But from 15 minutes, but I'll say even preferably from 1 hour, you'll find very good setup. Then I want to show you the rising wedge pattern. The rising wedge pattern. Now, this pattern is currently seen on BTC. If you join the morning analysis this morning, I was showing us this setup. It's a rising wedge. You draw a trend line on one side and you connect it. You join the the higher lows on one side and the higher highs on the other side. That's how you form your rising wedge pattern. You draw the trend line on both sides of price. Price enters into a consolidation and you see a breakout. And that's already on a BTC USD. Like I said, you can come down to lower time frame. Like this is 4 hours. You can do it on 1 hour. There are some setup I'm watching at the moment. This is GBP USD. This is a rising wedge pattern, and you can see there's already a breakout. But let's go back in history and look for. Let's just try to check this out, because this rising wedge pattern, they are very, very common. You will always see a lot of them. And it's very, very consistent. This is, you can see how I'm drawing it. You connect the higher highs, you connect the higher lows, and you need just about 2 higher highs or higher lows to touch the trend line to form a valid trend line. I don't want to take this one. I would prefer, let me look for another one. Sometimes you need to filter them. All right, I think I found another one. Now, don't force the trend lines to touch the higher lows. If it's not touching it, don't force it. But you can see there's a touch. What I mean is this: there's a touch here, and a touch here. So we are not forcing it in any way. Then we connect the higher highs, and you see this is a very perfect one. And see the massive breakout that happened afterwards. You can see the massive breakout. So you can see this works. So you can always do a back test on your system, to identify this. So this is a rising wedge pattern. And on Euro JPY, there's also a rising wedge. So that's on the higher time frame, but let's just look at it. All right. So recently, there was a massive breakout across board on the JPY PS like some 3 weeks ago. This is the Euro JPY side of it, and see price, traded within the rising wedge pattern. we have a breakout here, and that's a massive one. And you can still come down to 1 hour time frame to look for similar type of pattern. So I've shown you head and shoulder, inverse head and shoulder, rising wedge. Okay, we've not seen double top. Okay, this is a falling wedge pattern I'm watching on USDCHF. You can see how the lines touch, how I form the trend line, the lower high, and the lower lows. You can see them, lower high on one side, lower low on the other side, and I'm expecting a bullish breakout on this. So that's a falling wedge. Now let's look at, I want to show you a double top, a double bottom. Let's scan through where's the CHF if we can find any. Okay, this is a double bottom pattern, a letter W. Double bottom is letter W. This is the neckline. You can see as price broke out, see the force. That's why I said these patterns, you have to enter it with, a pending order. It's better, it's safer. There are times when the breakout may not be as massive as this. Let me try to find it again. There are times when the breakout may not be, oh, did I lose it? Let me go back. I want the screen to be big so that we can see it clearer. Okay, good. So this is it. W and a breakout. And here is the neckline. Though this is the tip of the neckline where you can kind of place your buy stop order. Now see the breakout candle in this case. If you don't use a pending order, you have missed the move. There's no two ways about it. You have missed the move, and that's an opportunity to make about 56 pips. You miss the move if you don't place a pending order. Okay, somebody is asking, Mr. Sonny Chiefs, what's the best time to analyze falling wedge pattern? Any time frame, sir. There's no best time frame. You can analyze on any time frame. What matters now, if you see it on a bigger time frame, like say daily, weekly, or 4 hour, then if you see a falling wedge on those bigger time frame, then you know that you are now looking for an opportunity to make your entry on a smaller time frame. So the other thing now is that, so what are you seeing? If you don't want to make your entry probably on 4 hour, if you don't want to do swing, then you want to make your entry probably on 1 hour or probably 15 minutes. So what are you seeing on those lower time frames? Is it now also giving you, an opportunity to buy? Because falling wedge means are you looking for opportunity to buy. So what you are seeing on the lower time frame, is it giving you an opportunity to buy? It doesn't have to be another falling wedge on the 15 minutes or 1 hour. It could be a candlestick pattern. It could be a double bottom pattern. You understand? So that's how we do these things. It doesn't mean the same thing you see on daily or weekly is what you see on 1 hour, 4 hour. You may not, in fact, mostly you will not. So you now need probably a candlestick pattern or another chart pattern to trigger you into the trade. So that's a double bottom. So let's see if we can find a double top. Maybe we should check another instrument. If you can find a double top. Okay, I just remember now, there's actually another double bottom on GBP USD some weeks ago. A couple of weeks back, yes. Now let me clean off all this so that we can see it. This is a perfect double bottom pattern on GBP USD on 4 hour, and see how far it's triggered price. It's been bullish since then. I'm telling you, from that 4 hour breakout, GBP USD has been bullish. It's a swing setup. It has gained about 527 pips as a result of that double bottom, that W pattern that you just saw right there. Yeah, this is swing. It's 4 hours, not 1 hour. And swing means you are ready to allow your trade to run for days, sometimes a couple of weeks. But the weights really what I mean, the result actually what the weight, if you can gain over 500 pips on a single trade, you know. And if it's on 1 hour, definitely maybe it could be like around 100 pips for that kind of setup. You can see it here, a double bottom. This is it, a W pattern. Let's see. All right, so we've seen the double bottom pattern. We've not cited the double top. Let's see. Let's just come through if you can. You can still find one. Now, if you don't find any pattern on a currency pair, please go to another one. So now this kind of setup is not the one you want to do and say it's only Euro US I want to trade. No, this one you have to check multiple financial instruments to find all these patterns. So you don't do it on just one, just don't just say on one currency. That's where you want to find all this. It may not work that way for you. You need to explore different currency pairs, sometimes on different time frames, because the time frame also matter. Time frame will depend on the frequency of how you see them. Okay, I think we just stop here. I'm not seeing anyone at the moment. Over time, we'll let you know when we'll find them. All right, let's take questions. If you have questions, just go ahead and drop it. Questions.
Good evening, sir.
Good evening, sir.
Good evening. Please, what
Good
is
evening,
the
sir.
best time
Hello,
to
good evening, sir.
Okay,
What
please,
is the
let's
best
take
time
it
to
one
exit?
after the other. Sir, you're saying what,
What
sir?
is, when is the best time to exit a pattern or trade?
The best time to exit a pattern or trade?
Yes.
Okay, let's take it one after the other. If you're talking about exiting a pattern, now there are take profit levels. Please, you've asked a question. I want to mute you because I'm getting some feedback from your end. If you want to talk again, you can unmute. Now let's take a look at a pattern like the head and shoulder, which I just showed us. I think we found it. Which of the pairs did we find it recently? Let's go back to the US oil. Now, okay, let's look at that setup I gave that time, which is here, a shoulder, a head, a second shoulder, and a drop. Good. And the neckline, the breakout below the neckline becomes our entry. Now, traditionally, if you check materials online, they'll tell you that for you to set your take profit level for this kind of pattern, you can put your crosshair tool, at this kind of area and drag it to the upper part of the edge, the tip of the edge. Here, this is giving me 1,646 pips. Then you now take it downwards and look for similar distance, for your take profit. So 1,660. So I'll drag it downwards also. 1,660. That's if our price didn't even get it. This is 1,004. That's the traditional way. But for me, when I trade this kind of patterns, if I generally speaking as a trader, I use my Fibonacci tool, for my exit. Exit as in profit exit, not losing exit. Now, profit exit. So I take it from the most recent low to the most recent high, and I target the Fibonacci levels. The first Fibonacci level in this instance is Fibonacci level 50, then Fibonacci level 61.8. Now, in my own style of trading, I actually also added another Fibonacci level, and it's allowed. If you go online, you find it 78.6, though it's not on the Fibonacci tool by default, but I made research and I decided to add it, so at least I believe price will touch the first two levels, 50 and 61.8. And in instances of extreme volatility, price may still go ahead to touch 78.6. So that's why I take. Now, as regards stop loss, your stop loss should be from your entry back to the tip of the edge. Now the question is, oh, but that stop loss is large. Yes, I agree it's large. But the truth about these patterns is that it is very rare. It's only maybe 1 or 2 out of 10 cases that after price breaks the neckline will now reverse back to go and hit stop loss. It is a very, very rare scenario. I'm not saying it cannot happen, but it is very, very rare. But at the same time, if you want to protect yourself, since we don't know when such can happen, the best thing to do is to make sure you use proper risk management, especially with your lot size. So don't say, oh, Mr. Rotimi has shown us the head and shoulder pattern. So once price break the lower, trend line, I mean, the below the neckline, I just trigger a standard lot. No, still practice the right rules of risk management. In fact, make sure you have a smaller lot size just in case, just in case things did not go as planned. So that's how I set even my take profit and my stop loss generally for trades aside chart pattern. So that's the second question that person is asking. So if it's chart pattern and even not chart pattern, this is the same principle I use, to set both my take profit and my stop loss. So I hope that answered that question. Okay, Kate is asking, finding the pattern, is it from the past trade? No, you are not finding, you are looking out for a pattern to trigger you into a new trade. So you're not, whatever we're showing you today is history. And that's why I showed you a couple of patterns that are forming, which is expected to break out soon. So if I find it now, let me tell you this. If you're looking for a head and shoulder pattern, now I used to tell my students this, when it comes to patterns, the truth of the matter is that as a trader, you will learn to complete a pattern in your mind before it is fully formed. If you don't learn to do that, you will miss a lot of opportunities. Yes, I agree at the beginning stage, you will miss opportunities because you are still trying to learn. But over time, you need to learn to take the bull by the horn and trade it and position yourself rather before the pattern is formed. We all know what the head and shoulder is. We all have our head, we have our shoulder. By the time the second shoulder is forming, as a trader, you should already, once it is halfway like this, you should know this is a head and shoulder pattern and position yourself below the neckline. That's what we're saying. Because if you want to wait, yes, while you're testing it, you will wait. Okay, is it true? Fine. Once you do that 1, 2, 3 times, next time you see a shoulder forming or a shoulder has formed, a head has formed, a second shoulder is trying to form, you should know. You should know. This is a head and shoulder. Position yourself and trade a breakout. So these patterns, you don't have to wait for them to be completely formed or you will miss opportunities. You will miss a lot of opportunities if you have to wait. So, but in the course of back testing, you are getting familiar with what these patterns are and how to spot them. Then in reality, once it's more than half of it has formed, you should know that is what we all know our letter W. We all know our letter M. We don't need to wait for letter M to be formed fully for us to know it's letter M. You understand? So that's how these things are. Okay, Sarah Yola. Sir, please, I'm a little confused. So please, is DJ30 the same as US30? Yes, it is. It's Dow Jones. Dow Jones Industrial Index is an index from the United States. It's the same. On some platforms, it's labeled US30. On the PE Prime platform, it's labeled DJ30, but it's still the same instrument. Which pattern is the most preferred and easiest to cite from experience? Well, I would say this one is my personal opinion, but then I believe it can work for you. Best thing you can do is to specialize in about 1, 2, or 3. Now, I mentioned quite a number of them, but specialize in about 1, 2, or 3 of them, that you can cite easily. For me, the ones that work best for me, if you've attended my analysis session, you will know the ones that work because I mention them often. Rising wedge and falling wedge, rising wedge bullish, rising wedge bearish, falling wedge bullish, double top and double bottom, head and shoulder, inverse head and shoulder. I don't joke with those 3. They come easy to me. I easily spot them. So if that's what, just look at the ones that are easy for you to identify. and just, put your attention on that. You don't need to trade. To be honest, you don't need to trade all of the patterns. You only need to be able to recognize few that you are confident and comfortable with, and you can easily spot and start back testing. What I want you to do tonight after this class is I want you to go back to your MT4 and start doing back testing. Start looking on different time frames and start trying to spot the pattern that has caught your interest. Maybe it's head and shoulder, maybe it's the double top. But to be honest, one of the most consistent pattern you find a lot is the head and shoulder pattern, the rising and falling wedge, followed by the double top and double bottom. They are very consistent. You will always find them a lot. But the other patterns too occasionally do appear, like the triangle patterns, the symmetrical triangles, the pennants, they do appear once in a while. So just do a lot of back testing. You'll find the one that works best for you. Emmanuel, good evening, sir. Thanks a lot for this wonderful exposition. Now, my question is this. When trading this pattern, is it proper to wait for a pullback before entering, or we just enter after a breakout with a penny order? Please, when you're trading chart patterns, you don't need a pullback. Just enter. Just set your pending order and close your eyes and walk away. You don't need a pullback because we're expecting a breakout. So there will likely not be a pullback. There will likely not be a pullback, except you want to wait manually for that. Well, look at this instance here. This is a head and shoulder. The pending order could have been placed just right here. You can see price broke and hit it. Was there a pullback? I don't think there was, and there was a continuation. So if you want to wait, sometimes I know there are occasions where it's possible price will go back and retest. I'm not saying it doesn't happen, but since you understand the pattern you're trading, that might just put you into some little negative trade, because if price hit this resistance level, we expect a continuation from there. Okay, let me show you one. If you've watched my analysis, I've been saying it since Monday that I'm expecting a bearish breakout on the GBP card. I'll show you now, what has happened to GBP card as at this evening. Just a minute, a second. Okay, so let's look at GBP card. All right, so this GBP card, this is a rising wedge pattern. It's a bearish reversal pattern. Now, as at Monday, price broke out. This is a breakout candle, but the parameters were not completely right for a sell. RSI was not clearly below 50. Then price retraced. That was a retracement. And I remember one of the analysis sessions, I remember telling us that we found a rejection candle right here. So price broke out and went to retest the trend line. That's an indication that we'll see a further bearish continuation. And that's what has happened. You can see our price has reversed. So in this, it is just a scenario that is peculiar. If you, in this case, maybe you want to wait, this like the retest in this case. But I tell you, in some other instances, it doesn't happen like that. It doesn't happen. So in this case, if you actually enter the sell, you will have some retracement, which is a negative trade, but it has reversed back now. The worst that could happen when this kind of scenario happens is that, or when this kind of scenario occurs, that price may go back and retest the resistance at the upper side. And when that happens, the chances are that it will now end up forming a double top. Now, it is possible to form a double top within a rising wedge, a head and shoulder within a rising wedge. Yes, two chart patterns can overlap on each other. It's a possibility. But like I said, if this happens, we may see price go up to hit there, form a double top, and still break out eventually. And that's why when you're setting your stop loss for this kind of setup, you use the tip of the some pips above the most recent high, because price could actually still go back to test that resistance before falling. So I hope that has answered a lot of questions. As we gradually begin to round up, I'll take a few more questions and we should be able to close for the night. So I believe after this class now,
Yes,
when you join our analysis sessions, you understand what we do better. Go ahead, sir.
no, sir. I see you
Hello, sir.
mentioned Finaboshi. Do we use Finaboshi also to trade, or I don't really understand? You made mention of Finaboshi.
Okay, sorry about that. I mistakenly muted you. I wanted to mute someone else. But I believe you are asking about the Fibonacci tool. Now, Fibonacci tool is a tool that was designed by an Italian mathematician called Fibonacci by name. That's his name. And this tool is very, very good when it comes to trading because it can give you insight into some price levels where price is projected to get to. So it has a way of not really predicting, but helping you to achieve more profitability because it gives you insight into some key levels that price would eventually drop to. So because of that, it has been adopted into trading, and the key levels that work most on the Fibonacci tool is the Fibonacci 50 and Fibonacci 61.8. So these levels are regarded as reversal levels, retracement or reversal levels. For example, now, if you have a sell trade on GPK, like I said now, most likely price will drop to Fibonacci 50 or drop to 61.8. Now, when it gets to 50, there's a possibility price might either retrace or reverse. The same thing is 1.8. So that's why those two levels are used as take profit levels. In some instances of extreme volatility, it's actually possible for price to drop below 50 and 61.8 and downwards. Sometimes people enter a trade and say, oh, you should target from your entry, target the most recent low, which is Fibonacci 100. The question is, there is no guarantee that price will get to 100. That's the truth. We don't control the market. There is no guarantee that price will get to 100 all of the time. But from experience and in combination with the Fibonacci tool, if you get your trend and everything correctly, if you get your analysis correctly, at the least, price will get to Fibonacci 50 or 61.8. That's why that you see that when we do signal analysis, we use two profit levels on the minimum. Can do two. Take profit one, take profit two. So if you set the 50 as a take profit one, you set the 61.8 as take profit two. The worst that will happen is that price will get to 50 alone and reverse, and you can close your 61.8 as a lesser profit, or price gets to 50, you close profit, get to 61.8, and you close a second profit. So basically, the Fibonacci tool is used to set your take profit and possibly your stop loss levels. So I hope I answered the question, sir.
Okay. I now understand that you mainly we use Fibonacci for profit taking.
Exactly.
I thought we use it for trading. It's for profit taking. Thank you very much.
Yes.
I understand what you're saying now.
Okay, Emmanuel, we need all the training on YouTube for mastery. Please, yes, go to the YouTube channel. You have all the training there. You have it.
Sir, please, I like to know, does it necessarily mean that if you take a trade on a 4 hours time frame, will your stop loss be kind of larger? One, secondly, in case, maybe there's a drawdown before the market goes back to your direction, does it really mean that, your drawdown will be large, unlike entering on either a 15 minutes time frame or even 30 minutes time frame? Thank you.
Okay, trading on 4 hours should be based on your personality and also sometimes your trading capital. There are 4 categories of traders. If you've attended our training, you'll be familiar with these terms. You have the scalper, the day trader, the swing trader, and the position trader. So trading on 15 minutes time frame, you could still be counted as a scalper. You're looking for just short moves, 5-10 pips move in the market. A day trader is making entry on 1 hour and is looking at 25-30 pips. While a swing trader is looking for something bigger than that. It's looking for 50 to 150 pips. So for somebody that is looking for 5 to 10 pips, and another person that is looking for 50 to 150 pips, their take profit is different. So also their stop loss will be different. So the swing trading comes with higher stop loss. When you're trading on 4-hour time frame, your stop loss is bigger than the person trading on 15 minutes time frame. But is it that the stop loss bigger should not lead to fear. what would determine your success is if this style of trading is suitable for your personality or not. If you are somebody that likes something happening sharp, then you can do scalping. It goes with your personality. But if you are the type that you like to take your things slow and steady, easy going, then swing trading may be okay for you. But at the same time, I will admit you need a reasonable capital. Now, if your capital is not too much, what I will advise with swing trading is that you trade with a very small lot size, extremely small lot size. So if you're having an account of like, if you want to do swing trading, you need maybe $200 or $300, and you have to trade just 0.01 lots. Yes, that's what you need to trade if you want to do swing trading on a small account, 0.01 lot. So you use your minimal lot size to mitigate against the risk, while also looking for a big profit if things go your way. So I hope that's answered your question, sir.
Yes, sir.
All
Thank
right.
you, sir.
Yeah. At what Fibonacci level is stop loss advisable? Your stop loss on Fibonacci should be at maybe Fibonacci 0, some pips, in a buy trade, some pips above Fibonacci 0. In a sell trade, some pips below Fibonacci 0. So that's how you can use Fibonacci for your stop loss. Where do we get this Fibonacci? It's on your MetaTrader platform. On the MetaTrader platform, if you come to this segment, can you see my pencil here? This blue circle, the tool in between. That's your Fibonacci tool. So you find it there. The link for the YouTube, please just go to YouTube and search for PU Prime Africa. Go to YouTube, search for PU Prime Africa. But occasionally we do drop the link to each of the training sessions. Also, we drop it in the WhatsApp group. But for fast access, just search for PU Prime Africa. The link to today's class will be dropped probably tomorrow morning. But then if you want a fast one, just go to YouTube and type PU Prime Africa. You see our channel, you see a lot of educative content there. All right, so I think I've answered all the questions. If there's any other question, I'll take just one more question and we should close. So while we're waiting for that question, don't forget this bootcamp continues on Friday by 7 p.m. Make sure you attend. And we're having physical training in Abuja and Lagos tomorrow. Abuja office 10:30 a.m., Lagos office 11 a.m. So if you want physical training, make sure you go to those two locations. And on Saturday, also the bootcamp physical session continues by 11 a.m., both in Abuja office and Lagos office. Okay, Mr. Amos will look into that. Samuel Omikunle, the recent classes are not on. That's not true. So I checked very well. They are there. They are there. There are about 5 to 6 videos there. Just check. You'll find them there. Maybe you are not familiar with the title of the classes we've been having. We started with the beginner's class, Introduction to the Global Financial Market. Then we add the MetaTrader class, MetaTrader Desktop, MetaTrader Mobile. Then we add the technical analysis class, trend lines, and support and resistance. Then we had the candlestick pattern class, and now we're having the chart pattern. So check it. They are there. But I will still compile the links and still forward to the WhatsApp group. All right, so that'll be all from us tonight. Please have a wonderful night rest, and we'll see again some other time. Bye-bye.
Thank you, sir. God bless you.
You're welcome, sir. You're welcome, Mr. Samuel.